I'm Grant Walker. Welcome to Last Call for Wednesday the 13th of May, and I'll be back with Heads Up tomorrow morning being Thursday at 10. Court news. A former financial advisor facing trial next week has pleaded guilty to stealing about $2.7 million of investor funds. Andrew Hrothgar Robinson, 42, was a director of Auckland-based Strategic Planning Group, but in September 2013, the SFO filed 6 charges against him following a joint investigation with the FMA. The fraud charges included 5 of theft by a person in a special relationship and 1 of dishonestly using a document. Mr. Robinson stole about $2.7 million to repay investments from other investors and to pay for some business and personal expenses between 2010 and 2012. Today, Mr. Robinson pled guilty in the High Court at Auckland and was remanded in custody. A sentencing date where convictions will be entered is yet to be set because of a disputed facts hearing on June 2, when Mr. Robinson will dispute the amount allegedly spent on business expenses. SFO Director Julie Reid is pleased the matter was resolved by guilty pleas. She says the investors in this matter took appropriate precautions and reasonably believed they were dealing with an honest advisor. Unfortunately, this is not always enough to protect people from fraud, as has proved to be the case in this instance. The FMA has laid separate charges against Mr. Robinson and 1 other person, which will be heard later this year. In July, Mr. Robinson was ordered to pay $2.56 million in damages plus costs to an investor over a series of negligent and misleading deals. Justice John Fogarty made the order against Robinson, a former Sunday Star Times columnist and advisor to Neville Mace and his family trust, over 6 disastrous investments, which were all made on the recommendation of Mr. Robinson as an investment advisor. To our dollar, the New Zealand dollar weakened after Reserve Bank Governor Graham Wheeler reiterated that he still considered the currency unjustified and unsustainable, key criteria for intervention. The Kiwi fell as low as 73.61 US from 74.03 before Wheeler's comments to Parliament's Finance and Expenditure Select Committee. The local currency had climbed from 73.54 at 9 after Wheeler omitted previous reference to its level being unjustified during the release of the bank's 6-monthly financial stability report. It was recently trading at 73.72. Mr. Wheeler said, "We still think the exchange rate is unjustified and unsustainable, even after a 5% decline on a trade-weighted basis over the last 3 weeks and a 7% to 8% decline against the Aussie." Mr. Wheeler told the committee we'd like to see more movement downward in the exchange rate.
NBR Radio, Wednesday the 13th. I'm John Stewart, and I'm joined now by our news editor, Duncan Bridgman, who's been following a story which says that up to 4 private equity firms are said to be circling secondary schools provider Academic Colleges Group, or ACG. So, Duncan, is ACG actually on the block?
Yeah, it certainly looks that way, John. There's a report in the Australian newspaper across the Tasman this morning which basically says that the company's appointed investment banks, UBS and Macquarie, to run a process in which will look at options to be sold the firm. And I've just had it confirmed actually about 5 minutes ago that there will be a statement that released shortly which will be along those lines, although not much detail is expected at this point, but so we'll wait and see what comes out of that.
Any idea why ACG should be sold?
Well, I think these type of businesses are pretty attractive to investors, particularly in Australia, and I mean prices are quite strong for these kind of businesses. This is an Auckland-based company, and it actually runs about 10 schools, including 8 in New Zealand, and it's got a couple offshore, and one in Vietnam and one in Indonesia. And there's certainly a lot of activity in this sector in Australia, and so maybe the owners, which include the Waterman Group, which is another private equity firm, just see an opportunity to exit.
Any idea what sort of value might be put on it?
It's difficult to say as a private company, although there is speculation that the company's annual earnings are around about $30 million, but reports that the asking price of up to $350 million New Zealand million may not be on the mark. So it may require a bit more digging to get those kind of numbers.
Indeed. Thanks very much for that, Duncan.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
NBR Radio, Wednesday the 13th. I'm John Stewart. And I'm joined by Nathan Smith with his weekly Foreign Affairs scope. Now, Nathan, the big story that has just broken today, I guess, is the future for the TPP after the Senate torpedoed it, at least for the time being.
Yeah, good word, torpedoed. It's obviously a lot of backroom dealings going on. The TPP's fast track promotional authority, the Trade Promotional Authority, is obviously something that Obama needs to push these through. It also will last for, I think it's 7 years, so there's a lot of other things on the agenda that's not just the TPP. But to support that, his Democrats and some Republicans are wanting concessions on the side of this for some of their own ideas, and this is just the way politics goes. But it is curious that they decide to torpedo it now, especially following some really useful words that came from Japan's Abe about a week or two ago.
Right.
And that relationship specifically is looking very strong. And a lot of analysts were expecting the TPP to push through with the Fast Track Authority because of that.
And we've got President Obama's fellow Democrat senators who've given this the thumbs down, but I gather quite a strong reason for them to do that, and it's traditional Democrat territory, is to protect the jobs of workers.
That is a major concern. I'm not sure how well placed that is for what the TPP, or what we know about the TPP and its effects on the global system. I guess that we'll just have to wait and see. We need more data on whether or not it will affect workers. But Democrats historically have been anti-free trade, which is one of the only free sentences that they are anti. And it's generally speaking the conservative Republican, the GOP over there, who are pro this, which is where a lot of Obama's support is coming from currently. So it's no huge surprise that Democrats are playing hardball on getting this passed. It's not exactly ideologically aligned with theirs.
Now, American Secretary of State Mr. Kerry has been in Russia this week. And, of course, he's had plenty to talk about with President Putin, Ukraine, Syria, Iran, and so on. So have we had any result from these talks yet?
It's he will visit Turkey next, so it's a bit of a stint he's doing in that region, talking to some of the allies, talking to some of the belligerents, trying to gauge what the next moves are on the ground. We'll get analysis pieces on what he comes back with in the following week. But yeah, you're right, he does have a lot to talk about. Ukraine is big on the agenda and what they need to do there. Also Syria, also the Iran nuclear policy, because obviously it works in Putin's favour to keep the US occupied in the Middle East as long as possible, and they look like they're going to be not having to do that very soon. So that's worrying them a little bit. But ultimately, Putin's position has been changing a little bit recently, and we can see that with the VE Day marches in Moscow just last week.
Because they were massive, weren't they?
They were very big, and they showcased a number of new equipment, especially the Armata tanks. And that's quite a solid display by Russia. They look quite powerful. Whether or not they can leverage that sort of power is another matter. But there are some things going on behind the scenes in Russia. Some things are changing. We don't know a lot about what that is, but just on the outskirts, 20 generals were dismissed right before those parades, and it's unsure as to why. But it seems to follow in Putin's recent footsteps, especially over the last 6 months, where he's getting rid of people that haven't performed or have made his policies not work as planned. Of course, he's not the one that's going to resign, but everyone else will.
Yeah, good old traditional Russian politics at work there by the look of it. Now, moving to ISIS and Iraq, Can you just bring us up to date as to what's been happening there and
Sure.
Baij and the Argil oil fields, Fallujah, the Kurdistan?
Yeah. This week there's been a number of large-scale clashes from security forces against ISIS, but they're also being included with the Kurds, which is useful for the security situation to make sure that cohesion of force stays. Those were the lessons from Tikrit, that although it was hard to press against ISIS with all those different competing factions all together, it was possible to maintain some sort of umbrella coherency over them. And hopefully that can continue into the future. These clashes show that potentially that alliance between the different factions is holding. We're unsure in the future. But 113 ISIS fighters were killed while they were trying to take some oil fields near Baij and Argil. But also in Fallujah, one of the main strongholds of ISIS and other Sunni militant Islamists is also now under severe targeting from the security forces. So that's good, but it's 11 months on from when the coalition forces started engaging ISIS. Recent estimates from US say about 9,000 ISIS troops have been killed, or ISIS fighters, I should say. But there are still some tensions on the ground.
Indeed there are, but at least the Iraqi army is working with the Peshmerga, I think they're called.
That's right, the Kurdish Peshmerga, yes, that's right.
Kurdish force. Now, of course, to Britain and the EU, with the elections over, and Cameron returning to number 10, people want smaller government, not bigger, and there are questions of nationalism and the anti-EU sentiment and so on. Can you bring us up to date with the wash-up from that election, Nathan?
Last week it was suggested, and I was just going by the pollsters, but that's no excuse, there was some suggestion that it would be tight, that there would be a hung government, but there wasn't. In the end, it was a clear majority by the Conservatives, although it is tighter than they have had in the past, which means any lawmakers or any politicians that decide against some of what Cameron wants, there wouldn't have to be many of them in order for them to fall below majority. So he has more constraints than he has had previously, but he is also showing himself to be a little bit more powerful, which will be important in his relationship, in the UK's relationship with the EU moving forward. Because what we saw in Britain was a microcosm of what is happening elsewhere in the EU, and as the EU as a whole, is higher anti-immigration thoughts, higher nationalist thoughts, and crucially, higher anti-EU thoughts as well. And that was sort of...
from outside Britain?
No, from inside Britain. Right. These are now threads that we're seeing come to the fore, exemplified in parties like UKIP, for instance, or the Scottish Nationalist Party. People who potentially don't like the status quo and would want to see it changed have now shown in the polls to actually be working on that change and operating under the auspices of those changes. And of course, just this week as well, we've seen some parliamentary elections in Germany, the crucial linchpin of the EU.
Yeah. And
for the first time, their parliament now has one seat of an anti-EU party, and that's quite significant. So the elections in the UK, while they are interesting and important for the UK, also show us something about how the rest of the EU is thinking, and that was definitely the takeaway.
Now, shifting south to Africa and the Central African Republic, there's been a peace agreement signed there. What's the significance of that?
Yeah, so 2 years ago, there was a rebel from the Salikas, a rebel takeover of the government. These are the Muslims against the Christians. Essentially, that's the thread running through here. But just to quickly wrap up what's going on there, the French troops are still leading the control of the peace agreements there, but it appears that both sides have exhausted themselves for the current iteration of this particular combat, which has been going on for a while, and the UN will now mediate the peace agreement moving forward.
And, of course, Yemen continues to be a complete mess despite a 5-day humanitarian ceasefire. Yeah. Well, listen, thanks very much for all your insights there, Nathan.
NBR With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
In investment news, Dorchester Property Trust, the hotel investor spun out of the financier and insurer formerly known as Dorchester Pacific 5 years ago, is holding a special meeting at the end of this month after a unit holder complained that the trust's managers were too slow in selling properties and returning funds to investors. The Wellington-based company said in a statement, LET Securities, owned by directors Deepak Gupta and John Southworth, is seeking enough votes at the May 29 meeting to be appointed as the manager of the trust, replacing Dorchester Hotel Property Trust Management. In a letter to unit holders, LET's Southworth says the current trust manager hasn't returned capital to investors quickly enough, with less than 21.5% of assets sold since the trust was established in June 2010, with the aim of selling its assets at the best available price and returning the sale proceeds to unit holders. LET says it owns about 6% of the trust's units and has support from other investors, giving it a total of about 15% of the units committed to vote for a change of manager. Dorchester Hotel Property Trust Management, a subsidiary of the NZX-listed Turners, which was previously called Dorchester Pacific, disputes LET's claims. It says more than $6 million has been returned to investors from property sales of more than $7 million, with remaining assets including the Goldridge Resort in Queenstown, serviced apartments in the Parkview on Hagley in Christchurch, and the Quality Emerald Hotel in Gisborne. It rejects suggestions from LET that its management fees were excessive, saying its $250,000 annual fee was reasonable and below market rates. It noted that calling the special meeting instead of addressing the concerns at the annual meeting planned for late August cost investors an extra $50,000 to $60,000. The current manager said that until recently there had been little buying interest in the hotel properties held by the trust, and its properties had also been hurt by earthquake damage. The current manager is putting forward a resolution at the meeting for it to accelerate the time frame within which the remaining properties are sold to no later than July 31st, 2016, with the trust to be wound up by November 30, 2016, when new rules come into effect, meaning the trust manager would need to be licensed by the FMA, incurring additional costs. It said LET could seek to sell the properties at a discount and still make a significant profit because it had bought units at a lower price than original unit holders who were issued the stock at $1 apiece. The stock last traded at 46 cents on the unlisted market, valuing the trust at $12.4 million. To TVNZ and those elections, a prominent TV commentator and most polled NBR subscribers agree that TVNZ should still bear the responsibilities of a public broadcaster and show political party addresses in election time. Yesterday it was revealed that in a submission to Parliament's Electoral and Justice Select Committee, TVNZ wants to cancel the opening and closing addresses because they rate poorly. The state-owned broadcaster says voters now have access to a variety of resources covering the policies of political parties to choose from, especially through the internet and social media. TVNZ has tried and failed to change the rules in the past. In 2012, it submitted a nearly identical proposal following the 2011 election. In its latest proposal, the broadcaster says ratings for the addresses in the 2014 election were 38% lower than the average of the 6 previous Saturday evenings. But TV commentator Dr. Brian Edwards says he's inclined to agree with the 67% of NBR subscribers who say TVNZ should have to air the addresses if that's what the government demands. He says they are a state broadcaster. They receive substantial state funding, and I think it's reprehensible that they're trying to pull this one. People are entitled to be informed about political party policies in election time, and TVNZ has that obligation. He said if you want to receive support from the government, if you want to be considered a public service broadcaster to some extent, I think you just have to bite the bullet. Dr. Edwards says he can see why 27% of subscribers said the addresses were tedious and should be ditched, but he argues that it's not a sufficient argument. The addresses are aired between 7 and 9 p.m. along with restricted advertising. Dr. Edwards says this is not a huge ask every 3 years. In the document, TVNZ argued that because it has a remit to perform like a commercial business, the mandatory addresses put it at a commercial disadvantage to its competitors. Some 10% of subscribers agree. If the proposal is rejected, TVNZ again wants the election coverage obligations extended to its commercial rivals. It says Parliament TV would be a more appropriate channel to screen the party addresses. For the financial year ended June 30, 2014, TVNZ received 15 million government funding, 4% of its overall revenue. It made a profit of 18.1 million. In the rural sector, according to the Reserve Bank, persistently low dairy prices are keeping New Zealand farmers under pressure, with about a quarter of dairy farms experiencing negative cash flow in the current season. The dairy sector, which produces New Zealand's biggest export commodity, is seen as a risk to the nation's financial stability, with low global prices for milk products weighing on cash flow, particularly for those farms with elevated levels of debt. Large deferred payments from last season's record payout have helped mitigate the decline in incomes, though the Reserve Bank still sees risks for the sector if prices remain low. The Reserve Bank said there is significant crossover between farms estimated to have negative cash flows in the current season and those with high loan-to-value ratios above 65%. About 25% of farmers, who account for about 32% of the sector's $29 billion in debt, are estimated to have negative cash flow this season as milk prices hang near 5-year lows and the outlook remains subdued. The bank estimates about 11% of debt is held by farms with high loan-to-value ratios of above 65%. The bank said in its 6-monthly financial stability report it's likely that the number of foreclosures among these indebted farms will eventually increase if weak cash flow persists for multiple reasons. Bank losses associated with these foreclosures would be exacerbated if land values fall alongside weaker farm incomes. The Reserve Bank has previously cited concerns about the level of indebtedness among a core group of dairy farmers, with about 10% of farms accounting for a third of the sector's debt. The bank said these farms tend to have higher levels of debt relative to output, leaving them more susceptible to worsening sectoral conditions. The Reserve Bank said private lenders have a largely positive view on the long-term outlook for the dairy sector and have been easing credit conditions for working capital. The dairy sector's fortunes will be largely influenced by how much Chinese milk demand recovers after it tapered off last year, following a build-up of inventories in 2013. The bank said some recovery in global milk prices is expected in the 2015-16 season, although there is considerable uncertainty over the timing and extent of the recovery. Assessing the balance of these global forces is difficult, but there is a significant risk that milk prices will remain low for an extended period.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
NBR Radio, Wednesday the 13th. I'm John Stewart. I'm joined by our political editor in Wellington, Rob Hosking, who's been going over in some detail the Reserve Bank's Economic Stability Report. Rob, what do you make of this?
This went a little bit further than I think people expected, say, a week or so ago. We did have a bit of a curtain raiser of it on NBR Online back at the start of the week when there was a signal, a quite sudden signal from the Reserve Bank that they were going to do something specifically targeted at the Auckland property market. In the past, of course, they've always said we can't do regional targeting. That changed today. It's important, I think, to take a step back from the property issue. This is not about cooling down the property market. This is about ensuring the wider financial stability of the New Zealand economic system. And basically, to do that, the Reserve Bank looks at any number of risks to that system. The three main ones I identified today were housing and the takeoff, particularly in the Auckland market, the debt in the dairy sector going into a season where a third of dairy farms are going to be cash flow negative. And the third one being yes. And the third aspect being global instability. They're all linked to some degree, and I think one of the things to keep in mind is that last one, which has got very little attention, is that global instability. They're talking about what if Greece defaults? What if there's a blow up in the Ukraine? What if, a little bit less dramatic, but what if when the US Federal Reserve finally starts lifting its interest rates, they don't know how the market's going to react to that. And there could be quite a dramatic effect around the world when that happens. And then, of course, there is the China slowdown and how bad that's going to be. So what they're concerned about is the impact of any of those things, plus, who knows, another 9/11, a blow up in Syria, anything, will have on financial risk and those money markets and where they might go. and what they might do, how they might respond to a shock like that. And when you've got the sort of high indebtedness that has been growing up in the Auckland property market, that sort of, when that money stops, because all this is funded through, well, not all of it, but a chunk of it is funded through 90-day rollover money, then you have a shock. And it's those stability issues that really worry the central bank.
When you're talking about debt levels, the Reserve Bank makes the point, as you mentioned earlier, that a third of dairy farmers are in negative cash flow. They're even using the F word, foreclosures. So does it look a bit, from the bank's point of view, does it look a bit grim for dairy?
Look, they see it as a temporary downturn, but the question is how temporary is temporary. If the fall in the dairy price doesn't last beyond the current season, then it shouldn't be too bad. If it drags on into the next season, farmers get into a second year with negative cash flow, that's when you're going to see some issues, particularly if around that time we start to see interest rates creeping up again. Because don't forget, we've got historically low interest rates at the moment. They are expected to start moving soon. Now, who knows? But even aside from the interest rate issue, and we'll come back to that in a minute, there's only so long you can keep kicking cans down the road. And if you're a farmer who's on high debt and you move into that sort of second year of negative cash flow, then you start having some issues. And, that's when you might see a few foreclosures. So, again, and that's pretty much the global situation. This is, again, I think people have got a little bit too fixated on the Auckland property market. It is one part of the risk jigsaw here. And it's a highly dependent one on these other factors. And they're global factors, commodity prices, dairy in particular, and that global situation, which is, as I said, China, US, EU, Greece, you name it.
With the Auckland property prices, we have canvassed that in an interview with the chairman of the Property Investors Federation. But from where you sit, do you think it will have the effect of dampening down Auckland property prices, particularly from the point of view of those who simply buy houses as an investment? And let's bear in mind that there could be quite a spin-off there in terms of increased rents.
Well, the thing is, rents have not gone up, and that's one of the things. The Reserve Bank dropped a very, very, very... There was a very strong nudge in the ribs at the IRD and the government generally today. Basically, the Reserve Bank is saying, our data shows there's a lot more buying and selling for capital gain than your tax system is actually picking up. You need to have a look at this. They're a little more subtle about it than they were a few weeks ago when Grant Spencer made that speech, but that was the underlying message of a lot of data here. I suspect we might see a little bit on that in next week's budget. Nothing sort of, not capital gains tax or anything like that, but I think the government's going to move up to enforcing those existing tax rules a lot more rigorously. Now, whether that will have an effect on the property market, I don't know. Auckland property market has become a bit like the currency markets. Only a fool tries to predict it. The big driver in the Auckland property market, as we know, well, there's a whole batch of big drivers, and one is supply, and that's tied into population growth, which comes back to immigration. They need to build 9,000 new houses a year just to keep up with immigration.
And we've got to remember internal migration too, as people move to Auckland. Yeah.
And just, people having babies and stuff, which they still do. So that's sort of 9,000 a year just to keep up with migration. Then you've got natural population growth and, as you say, internal migration.
Yeah.
So I can't see much of a slowdown in Auckland. There may be a mood shift. There was when the LVRs came in. They had a bigger impact than the Reserve Bank expected it to. And it is possible that this will have a bigger impact than they're expecting this time, but I wouldn't hold my breath on that.
Any hint from this stability report of a change in the OCR?
They always get very po-faced and serious and quite... if you sort of ask them to comment on the OCR in this, because it's a different area of what the bank does. But at the same time, it's worth noting that the Reserve Bank, what it does with the interest rates, has to pay heed to financial stability. So there's a link there. So, and I do wonder if, I know people are saying, they're going to cut once they get this bedded in. I don't think they are necessarily. I wouldn't be picking any change in the OCR just yet. I don't see anything this year.
Rob, thanks very much for that.
NBR Radio. Free to air online with business news you can use.
To the food price index, New Zealand food prices fell to a 4-month low in April after discounting in supermarkets and cheaper fruit and vegetables. The food price index fell 0.3% in April after a 0.1% gain in March, taking the measure to its lowest level since December, according to Statistics New Zealand. On an annual basis, food prices were 1% higher in April than they were in the same month last year, rising at a slower pace than March's 1.9% gain, which was the biggest increase in 3 years. The food price index makes up nearly 1/5 of the broader consumer price index, which has dropped below the Reserve Bank's 1 to 3% range, rising at a 0.8% annual pace in 2014. Reserve Bank Governor Graham Wheeler has kept the official cash rate on hold at 3.5% since September, but flagged any further downward surprises in New Zealand's already tepid pace of inflation may warrant an interest rate cut. Traders are now pricing in a 46% chance of a rate cut at its next meeting in June. On a monthly basis, grocery foods, which make up more than a third of the index, dropped 0.9% in April, as discounted cakes and biscuits slid 6.3%. Milk, cheese and eggs, which make up part of the grocery measure, fell 0.4%, led by a 2.2% drop in cheese price. Fruit and vegetable prices fell the most in the month, down 1.2%, as seasonally low fruit prices offset a 0.1% increase in vegetables. Meat, poultry and fish prices rose 0.4%, with beef prices now at their highest level, according to Stats. Restaurant meals and ready-to-eat food also increased 0.2%, and non-alcoholic beverage prices rose 0.3%. The annual gain was led by a 5.3% jump in fruit and vegetable prices, as New Zealanders paid more for lettuce, potatoes and tomatoes, while bananas and strawberry prices also rose. Meat, poultry and fish rose 2%, restaurant meals and ready-to-eat food price increased 1.6%, and non-alcoholic beverages were up 1.8%. Grocery food prices fell 1.5% in April compared to the same month a year earlier, as prices for bread, butter and cheese fell. Now, reaction to the new lending rules. Andrew King of the New Zealand Property Investors Federation says the Reserve Bank has missed the mark with its decision to hit Auckland property investors buying existing houses with a 30% deposit. The rule won't apply to investors building new houses. Mr King says the Reserve Bank has not taken a wide enough look at the entire Auckland property market. He says the reason house prices are soaring is simply supply and demand. He says the numbers of people pouring into Auckland through internal and overseas migration is the main issue. There just aren't enough houses, and developers are not able to get new houses to the market quickly enough. Mr King says the higher deposit rule for investors buying existing properties will hit tenants hard. Some investors may get out of the market, and there is always churn through older investors cashing up. He says investment housing being sold often goes to first home buyers using their KiwiSaver, and this takes homes that can house 4 to 6 tenants out of the market. As supply becomes tighter, rents inevitably will rise. He says the rule will keep new property investors out of the market and will not solve Auckland's perceived housing crisis. People, he says, have complained about house prices, and the Reserve Bank thinks it has to do something, when in fact there is very little it can do. Mr King says there is no easy solution, and keeping potential investors out of the housing market is not the answer. To today's RBA statement, the Reserve Bank Financial Stability Report is a 62-page heavy-handed hint to inland revenue. As signalled by NBR Radio earlier this week, the Reserve Bank is targeting property investors in the Auckland region. Such investors will have to have a deposit of 30% of the value of the property. That's aimed at all property investors in the Auckland Council area, with the exception of those investors building new houses. In a partially compensating move, the existing speed limit for high loan-to-value ratio lending outside Auckland will be adjusted from 10% to 15%, although the 10% will remain for loans to owner-occupied houses in Auckland with mortgages of greater than 80% of the value of the house. The measures will take effect from October 1, but in the meantime, banks are warned to keep within the spirit of the rules and not engage in a splurge of lending to beat the changes. The new rules are effectively an extension of the loan-to-value ratio restrictions implemented nationally from October 2013. Those rules were effective for a time, the report released this morning says, but that effectiveness is now waning, and in any case, the big danger to the stability and well-being of the financial system is the Auckland property investor market. The subtext of much of the analysis of the Auckland property market contained in today's report is plain. These investments are being made with the intention of selling for capital gain, and therefore the capital gain should, under existing Income Tax Act rules, be included in property investors' income and taxed accordingly. Many property investors already do this, and Inland Revenue has been going after those who do not with increasing vigour since 2007. Today's report stresses the risk the recent Auckland property frenzy puts the country's entire economic system under. And for more on today's report, go to nbr.co.nz.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. Reaction from investors on the new Auckland rules. The Reserve Bank has a warning for insurance companies. Food prices fall. More details on the new Quake rules and several restraintive trade cases. To find out more on those stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio.
NBR Radio, Wednesday the 13th. I'm John Stewart. The Australian budget was announced on Tuesday night, and it's much different from last year's. Instead of talking about an end to entitlement and widespread welfare and other spending cuts, it's about spurring economic growth. In his editor's insight on Wednesday, Neville Gibson examines the contents. Neville, in what way does this budget differ from last year's?
Well, in just about every way. Hockey stick graphs are noted for their low dip at the beginning and the bottom, and then rising sharply into a vertical mode. And that metaphor, of course, named after Australian Treasurer Joe Hockey, is a good description of his budget, which starts with a bit of a dip with growth going down slightly, and then there's a forecast of a strong upward movement in the next few years. But it's not just a budget that aims to recover political ground lost by last year's budget, but also it says that Australia will be on quite a growth trajectory in the future. You're starting at a pretty low point. You're talking about a $40 billion deficit in the current year that ends in June, and then a surplus within 5 years, which is pretty ambitious, but it's based on Treasury forecasts over there of growth easing off in the current year to 2.75%, and then a pretty fast recovery of well over 3% by 2017.
So where does Mr. Hockey expect the growth will come on the vertical part of his hockey stick graph? Where does he think that will come from without mining?
Well, it's definitely mining is the problem in Australia, but he's put his faith in 2 million small businesses to fill the gap left by the collapse of revenues to the government over there from oil, iron ore and coal. These businesses will have 1.5% cut from their tax rate of 30%, which applies to all other businesses. They also get a write-off of $20,000 from their tax if they buy capital items. Now, this will mean big queues of people, I imagine, getting out to office supply firms and toolkit makers and that sort of thing. Mr. Hockey says this is giving business to let's have a go. And, of course, you'll be able to buy new tools. You might buy espresso machine if you run a cafe. Maybe even employers will buy smartphones for the employees. Who knows? I mean, there's a little bit of a danger on this backfiring, because if these businesses start spending and they get up to that $2 million threshold, they'll start paying the higher tax rate again.
Now, budgets always affect families and pensioners. What's in it for them?
Well, this is the other key point of the budget, and the main package which we've discussed earlier was the childcare support, and that's to get more parents out to work. So Australian families are going to have a much more subsidies from their childcare costs, that kind of thing. But there'll also be a bit of a those who can double dip. In other words, they've got more generous private schemes that they won't be able to get both. So there's a little bit of a clawback there. The pensioners, well, they are pretty much left alone. There was calls for a crackdown on people who've got a lot of money who are also getting a state-funded pension. They have gone unnoticed, but there's a little bit of tinkering there. But generally, most pensioners will still be no worse off, at least.
So who are among the losers?
Well, there's a few of those, and Not very many, though, and none of them vote, and they're already unpopular. They include backpackers on working holidays. This was a bit of a surprise, about the only surprise there was, actually, in the budget. They'll lose their tax-free thresholds that every Australian gets of around about $18,200. They'll have to pay tax on every dollar they earn, and that's estimated to bring in well over $500 million. Foreign investors, well, they're going to be paying extra fees to make any transaction like buying a business. There's also going to be, if you're buying land, they're going to lift the threshold there for investigation into how you're going to fund it and that sort of thing. We've heard a lot about the 30 companies like Google that are going to be paying extra tax, and of course there's going to be a GST applied to all those digital download services, the so-called Netflix tax.
So when will all these measures kick in?
Well, they all come in at different times, but
Right.
some of those foreign investors ones start in December, some of them next year, but they start all over the place actually, and
Yeah.
a lot of them run for 4 to 5 years.
So summing up, how would you rate this budget?
Well, most of the commentators I've looked at have praised the budget as being very politically savvy. There's no nasty surprises in there. It's aimed at pulling back a lot of that support the coalition lost last year, particularly among those of its potential voters. It's unlikely to shift a lot of hardcore Labour voters, of course, but if you're looking at harder-edged commentators in the economic area, they say the government could have done a lot more to improve its fiscal position. Those deficits are really big. I mean, they could have raised the rate of GST from 10% to more like our one of 15%. Negative gearing still there. Taxing on super has been left alone pretty much. And they could have looked at one or two industries where costs are quite high and they're protected, like pharmacy and taxis. But generally, Mr Hockey and his colleagues have learnt their lesson, and they've got an election towards the end of next year, so they're looking at that one, I think.
Neville, thanks very much for your editor's insight today.
NBR.
Radio.
Free to air online. NBR, the meeting place of intelligent business.
To insurance and the Reserve Bank, insurers may face unexpectedly bigger costs over the Canterbury earthquake after several firms recently increased their estimates for the final bill, according to the Reserve Bank. The central bank now estimates the cost of the 2010 and 11 quakes that devastated New Zealand's second biggest city will be between $33 and $38 billion, and says there remains a risk of negative surprises to individual insurers. As at March 31, insurers had paid out $24 billion in earthquake claims, and increased costs have been funded through a combination of reinsurance, reduced existing capital and injections of new capital. The bank said in its 6-monthly financial stability report, in aggregate, estimated outstanding Canterbury earthquake claims have not reduced by much in recent months, with payments roughly matching increases in estimated ultimate costs. The substantial claim amounts still outstanding suggest it will be challenging for insurers to meet their announced target for completing the settlement of all Canterbury earthquake claims within the next year or so. New Zealand's general insurance sector has been benefiting from global trends where firms have found it relatively easy to raise capital, which has made reinsurance costs cheaper, though Asia-Pacific rates are higher than in other regions. Those falling costs have put downward pressure on domestic insurance premiums, though the Reserve Bank said that hadn't necessarily been fully reflected in retail pricing, with some insurers exposed to losses from recent regional weather events. The Reserve Bank said in this competitive market it's important that insurers maintain sound underwriting standards so that premiums remain appropriately priced in relation to the risks. The bank reviewed the quality of insurers' risk governance through the second half of last year and found that while the quality was varied, insurers recognised the importance of risk governance. In business news, Rural Equities, the farming group majority owned by the Cushing family, will sell its 6.4% stake in ASX-listed Tandao into a takeover offer from Australian agricultural and water company Webster. Webster's shares have jumped 26% on the ASX this year, and the stock is rated a strong buy based on a Reuters survey of analysts. Webster is Australia's biggest vertically integrated producer of walnuts, accounting for more than 90% of the nation's export crop. It's been on an acquisition spree, buying water entitlements and more than 45,000 hectares of land known as the Kuba Aggregation for 116 million Australian in December. and making a $124 million offer for Bengerang, a large-scale New South Wales cotton farmer with its own portfolio of water entitlements. Tando, which listed on the ASX in 1987, owns about 143,000 hectares of land in cropping, water and pastoral operations. Deputy Chairman Roger Finlay said Rural Equities will become a shareholder in an enlarged Webster Group, which will be one of the largest water entitlement owners in Australia and a high-quality producer of cotton, cereals and walnuts. The new organisation provides increased scale together with enhanced crop and geographic diversification. Mr Finlay said Hawke's Bay-based Rural Equities would end up with between 2 to 4% of the enlarged Webster, with the deal still subject to approval from Webster shareholders and with the Bengerang acquisition also funded via the issue of Webster shares still pending. Rural Equities paid about 45 Australian cents for its Tando stake, which it built in conjunction with the Cushing family in 2013, before lifting the holding to 21% last year by participating in a rights issue, only to sell down the holding to its current level to fund other activities, including debt repayment. Tando shares were last quoted at 66.5 Australian on the ASX. Mr Finlay said based on the current Webster share price and exchange rate, the takeover offer values REL's Tando shares in excess of $3 million over REL's book value. Post the acquisitions, Webster may be a large enough company to be included in the S&P ASX 200 or 300 indexes. Tando was the subject of a takeover bid by Guinness Peak Group in 2009 and 2010. In an offer the target company then said was an attempt to take control on the cheap. GPG sold its stake in 2013 for 12.8 million Australian or 36 Australian cents apiece. In business news, oil producer and explorer NZ Oil and Gas has been forced to can a planned shareholder meeting after falling foul of the takeovers panel. The company had wanted shareholders to approve a share buyback that would increase the holding of its major shareholder Zeta Resources, a Bermuda company associated with investor and Infratil director Duncan Saville. In a statement to the NZX late on Tuesday, NZ Oil and Gas said its notice of meeting had been withdrawn because the takeovers panel had advised it considers that the notice does not adequately describe the persons whose voting control may increase as a result of the buyback. The panel believes the omission is material information. Consequently, there will be no meeting on 21st of May 2015. In December, New Zealand Oil and Gas proposed a buyback of 64 million shares on market, an amount equivalent to 19% of its shares on issue. It said it was doing the buyback because its shares were undervalued from time to time, and a buyback would improve shareholder value for those who did not sell. The program would take place over up to 4 years. If Zeta chose not to sell into the buyback, its stake would increase from 19.9% to 24.5%. New Zealand Oil and Gas said it may reschedule a special meeting or seek the relevant approvals at the annual meeting later in the year. Zeta Resources, listed on the ASX, is 82.7% owned by Utilico Investments, a Bermuda-based investment fund managed by ICM, whose investment manager is Mr Saville.
NBR Radio with Hotel The Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
NBR Radio, Wednesday the 13th. I'm John Stewart. Now, the Reserve Bank has put out its economic stability report, and that involves quite a crackdown on people who are investing in existing houses. In other words, not owner-occupiers, but property investors. I'm joined by our property reporter, Sally Lindsay, and on the line, the Property Investors Federation's Andrew King. Now, Sally, can you just give us a rough idea of what the Reserve Bank has recommended? And it is only for Auckland, for deposits for this class of investor.
It is only for Auckland. And from October the 1st, banks or property investors will have to pay a 30% deposit on existing houses, but they will be able to still stick to the 20% deposit on new houses. The Reserve Bank thinks this will stall the property market in Auckland. It is doubtful it will do this. And because it believes that property investors are only buying properties for the intention of selling capital gains, and they're not actually keeping them in their portfolios for any other reason. This has not gone down well. And Andrew, what do you think about it?
Oh, I think the Reserve Bank have misjudged things, really. in the current situation, I think house price growth is really being pushed by the high levels of migration we've got. And in fact, 53,000 people, and most of them are coming to Auckland. I think that's the real reason why house prices are going up as fast as they are. So it's unlikely, as you say, that this is going to have much of an effect.
What is really happening in the property market? Is there a bubble, as a lot of people say?
No, I don't think it's a bubble. I mean, it all comes down to definition, but it doesn't appear to be a bubble to me. A bubble to me is something where everything is out of kilter, and it's just going to take one small little prick and that whole thing will burst and it'll absolutely collapse. And there's just nothing showing that that's likely to happen. In fact, I think we've probably got a year or two of house price growth to go, simply because of the supply-demand situation.
I suppose this comes down to the council's or previous council's inability to plan for growth over the last 20 to 30 years and make sure there was enough land supply for new housing.
Well, that's part of it. Although that does come down to policy decisions about whether you go up or whether you go out. But yeah, that certainly is part of it. But then there's all the development contribution fees. There's all the council fees. It's around about $50,000 of fees just before you even start building in Auckland. So that's having a definite impact. There's many other things though. There's the size of the houses that we're building. If we build smaller houses, that would have a definite positive impact on affordability.
But people have got used to living in bigger houses and they don't want to move into apartments as they seem to think they're packed in like sardines in other countries.
Look, that's true, and that's fine. If that's what people want, I think that's fine. But they need to realise that bigger properties on bigger bits of land cost more. And we do in New Zealand tend to have bigger houses on larger bits of land, similar to Australia, really.
So do you think the Reserve Bank's decision will have an effect on the market, on members of your federation?
I think it definitely will have an impact. I mean, 30% is a fairly steep hurdle to get over. So there will certainly have an impact on the amount of new rental properties being bought. I think how it really will impact us, though, is that at any given time you've got new people coming into the market, and you've got people exiting the industry, so selling their rental properties. Often they would sell to the new people coming in. That's the way it would go. As that market dries up, I think a lot of the exiting rental property owners will sell to first-home buyers. And some people may say that's a good thing, but it does have a real impact on supply of rental property. And even if you've got a tenant who is actually the first-time buyer, so a lot of people think that's just a straight swap, but it often isn't. Often you'll have a couple buying a three-bedroom house, but then you've got 3, 4, 5, 6 people who used to be tenants in that house now need to find somewhere else. So the number of people per property is much lower for owner-occupied housing than it is for rentals. And I think you've also got to think that with this high level of migration we've got at the moment, a lot of the first-home buyers are actually migrants or they're ex-Kiwis coming back to New Zealand. And so they're not tenants, they're just buying a rental property, not a rental property, a new home that used to be a rental property, and that has a direct impact on supply. So I think we're definitely going to see a reduction in supply of rental properties, and that can only lead to higher rental prices for the parole tenants.
How much has this affected the industry already by migrants buying houses just for themselves?
I think it has affected a little bit in different areas too. A lot of the houses around central Auckland that used to be perhaps for students' houses it's now being bought by people and done up, and as the value of that property increases, it's being done up, and a lot of students are now finding it hard to get cheap accommodation close to the central city and close to universities. So, yeah, things are definitely having an impact, but it's not just on the rental property owners, it's more on the tenants actually.
Well, Andrew, we'll have to wrap it up there, but thanks for those insights, and thanks to you as well, Sally.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free, and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
In education news, local secondary schools provider Academic Colleges Group is exploring sale options according to Australian media reports. The Auckland-based company, which runs 10 secular schools, including 8 in New Zealand, has appointed investment banks UBS and Macquarie to run the process, according to a report in the Australian newspaper. Private equity firms Pacific Equity Partners, Quadrant Private Equity, Champ and Archer Capital are thought to be interested in the business, according to the paper. A share market listing has also been one option, although less likely than a trade sale or private equity buyout. Founding investor Danny Chan still has a sizable stake in the business after buyout firm Waterman Capital acquired a 24% shareholding in 2013. ACG made its name with the launch of campus-style private schools before expanding into language teaching and university foundation programs. ACG's first ventures, the Senior College of New Zealand and New Zealand International College, opened in 1995 and were funded by 40 private shareholders. ACG then launched Junior College Forms 1 to 4, then Strathallan College in Karaka and ACG Parnell in Auckland. Recently it bought Digital Design College UB School of Design. It also has one school in Vietnam and one in Bali, where it's planning to open a second school this year. Across the ACG group, there are approximately 5,000 students and about 780 teachers employed. And now an update. Propeller vows to continue fight. Propeller Property Investment says it will fight on despite a judge ruling against temporary relief in a restraint of trade case. As reported earlier, Propeller lost an initial court bout to restrain former contractors Trevor Moore and Michael Hackett from acting in competition for a year. The company, founded by property commentator Nikki Connors, has since released a statement saying it will continue the court fight as it believes the pair breached their contractual obligations of confidentiality, non-solicitation and restraint of trade. The company says while interim orders were not made, the High Court found that Propeller has an arguable case against Mr Moore and Mr Hackett, and it will continue to pursue the proceedings to protect its integrity, business and intellectual property. The statement says the company believes its business has been built by dedicated staff and management to become a leader in its field. It's not prepared to allow anyone, it says, including past contractors, to take advantage of those efforts for their own gain or for the benefit of its competitors. Ms Connors gave evidence that Mr Moore and Mr Hackett were the core of Propeller's presence in the Auckland area, and the firm had invested significant time and money training them. However, the pair signed affidavits saying they had not attempted to solicit, divert or appropriate any clients or property developer relationships from Propeller. While Justice Mark Wolford acknowledged the business was in competition, he declined an interim injunction to stop the property consultants. Now more details on the new quake rules. Councils around the country have yet to determine exactly how many buildings are affected by new seismic strengthening rules and to what extent. Although there are estimates the cost of the new rules will be about $777 million rather than the earlier $1.3 billion estimates, no one really knows. Business groups have welcomed the watering down of rules by Housing Minister Nick Smith. The time frame for identification and assessment of 5 years and strengthening of 15 years is to be varied relative to seismic risk. Estimates for the return period for a significant earthquake range from 120 years in Wellington to 720 years in Christchurch, 1,700 years in Dunedin, and only once every 7,400 years in Auckland. Dr Smith says New Zealand is to be categorised into low, medium and high seismic risk zones with timeframes for assessment of 5, 10 and 15 years and strengthening of 15, 25 and 35 years. Education and emergency buildings will be targeted by requiring that in high and medium seismic risk areas they be identified and strengthened in half the standard time. Dr Smith says we are prioritising all education buildings regularly occupied by 20 people or more. We also want to ensure buildings like hospitals can maintain services in the aftermath of a significant earthquake. The scope of buildings requiring assessment, he says, is to be reduced from an estimated 500,000 to 30,000. He said we're excluding farm buildings, retaining walls, fences, monuments, wharves, bridges, tunnels and storage tanks. The new methodology for identifying earthquake-prone buildings will ensure the focus is on older buildings with unreinforced masonry that pose the greatest risk. The government also confirmed that the earthquake-prone building definition as being less than 34% of the new building standard, a 10-year extension for listed heritage buildings, and exemptions from strengthening for low-risk, low-occupancy buildings would remain in the policy. Dr Smith says the effect of these policy changes is that buildings such as schools, universities and hospitals in high and medium seismic risk areas will have to be upgraded more quickly, but buildings in low risk areas like Auckland and Dunedin more gradually.
In NBR Radio with the Property Press. It's out now to show you around.
NBR Radio, Wednesday the 13th. I'm John Stewart. I'm joined by our macroeconomics reporter, Jason Walls, who's written a lengthy think piece, for want of a better word, on the situation in Europe. Jason, is it doom or gloom?
Well, that's a good question, and that's basically why I've been going into this piece. There's been a lot of people saying lots of different things about the situation in Europe, and what initially sparked my interest, not my interest in the subject, because I've been writing about this and talking about this for months now, but to do this particular piece was an economist that came and talked in a New Zealand, an Auckland meeting the other day, and he was just talking about how Europe's doing and about Greece and things like that.
Yeah. I mean, most of that coverage is on Greece has been pretty negative.
Yeah. So I'll get to Greece a little bit later. But
sure. So who was the economist?
Well, the economist is this guy called Jonathan Payne, and probably his most noteworthy thing that he does is publish something called the Payne Report, and it's a really long, dense piece of economic reporting. Well, not reporting, but a very dense piece of thinking, and it just goes into a lot of detail. And he was here last week, and as I said, he was just talking about Europe, US, Indonesia, China, and I took a particular interest in Europe. Because he gave it the most glowing recommendation I've heard in a long time. And it was almost bizarre to hear, after I've been talking about the negative situation in Europe and a lot of the things coming out of Greece, for somebody to be standing up there and saying things like, happy days are here again, and just giving it basically 5 stars. So he was saying things like zero interest rates were really, really good as they promote lots of spending, which is technically true. And oil prices have kept the Eurozone, kept the euro low, which he said, again, is a good thing. And he was just talking about how it was bouncing back. So, yeah, in fact, the thing that he said that we need to all take out of his seminar is that the fact that truck sales have actually been spiking and more people are buying trucks, that is a key economic indicator that the continent of Europe is actually doing quite well. And his argument to this was that if people are buying trucks, it means that they can afford trucks, essentially, and it means that you're shipping things, trucking things, around the continent, and it looks better for everybody.
Is Jonathan Payne's an unusual view?
Well, no, it's not, and that's why I was really, really interested by this. I mean, there's some economists that say, yeah, it's doing okay. There's some that just absolutely bash it and say Europe is in really dire trouble right now. And one of such economists is Dr. Oliver Hartwich from the New Zealand Initiative. And I called him up just this morning, actually, and I said, I outlined what Mr. Payne was saying, and his first comment was, are we talking about the same continent here? Like, he just couldn't, he was just blown away that this idea of Europe is just so fantastic. And he was talking to me about negative bond yields in Europe and how interest rates, again, are almost 0%. And the ECB have been printing money just at an alarming rate. I mean, their quantitative easing is just huge. And he was telling me that, I mean, this is all well and good now, but what's going to happen in the future?
And then there's Greece.
Yeah,
we talk a lot about Greece with you, Jason.
Oh, yeah, Greece. That's I have to go there someday because I'm writing and talking about it so often. It'd be good to get an actual view of it. But, then there's Greece. And it's a fascinating piece of economic history that we're seeing unfolding in front of us right now.
What are Dr. Hartwich and Mr. Payne saying about Greece?
Well, that was the one thing that they were both in agreement about, actually, is that Greece is heading for a default. And it was a lot of people are kind of tiptoeing around this idea. Will they, won't they default? It's hard to get a specific opinion from one economist, but it's nice to, well, not nice, but it's interesting to see people say this is potentially what's going to happen and say we're heading for a default, which is scary because this is the first time a country will have defaulted on IMF loans in history.
Well, why are they pointing to a default?
Well, there's just too much debt, John. That's the problem. There's just so much debt. At the moment, Greece's debt clock has reached more than 300 billion euros, and that's 200% of their GDP. And to put that in perspective, that's 2.5 times the size of New Zealand's GDP just in debt. So it's just too much money.
Pretty mind-boggling figures, but they have been making payments to their creditors, though.
Yeah, they have. They made a $200 million interest payment last week, and they made a $750 million euro payment this week. But the euro payment, I mean, it's $750 million. Although it's good, it's still not enough money when you look at that huge, enormous, just giant mountain of debt. They're doing other things to get money, but it's just this really it stinks of desperation, really. I mean, they just put an 18% tax on tourists. And a country like Greece, I mean, can you imagine what would happen if we did that in New Zealand? So we rely on tourists. It's one of our biggest industries. It'd be an uproar. I mean, we'd lose so many tourists because they'd see this number and be like, well, it's going to cost me more money. Greece is just like built for tourism, basically. I mean, it's got all the ancient history and the culture. And this huge tax has just been labeled catastrophic by people around the world that are very up to the know in tourism and things like that. And you'll know, since we've talked about it last week, about the desperate move the Greeks made when the government passed a law which required public sector entities to transfer idle cash into reserves to the central bank. So it's just basically them scraping together all this cash. And it's just like they're already hitting the bottom of the barrel now. Where else are they going to look? And they've still got so much to repay. And something that Mr. Payne said, which I found was one of the greatest pull quotes I've ever seen in my long 6-month history of being a journalist, was like every Greek tragedy, we know how it's going to end. We just don't know how long it's going to take. And I thought that just encompassed the whole situation beautifully.
Well, it begs the question, I mean, what happens when they do default?
Well, that's the $1 million question. In fact, let's call it the 300 billion euro question. It's anybody's guess, really. It's there's scenarios out there where if Greece defaults on the debt, other countries such as Spain and Portugal might say, hey, well, if they do it, we can do it too. And there's maybe this domino effect. I mean, this is all speculation, of course. But yeah, as I say, it's practically anyone's guess at this point.
Jason, thanks very much for those insights.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.